Hey, this is Compounding Wisdom with Gio and Paul, a show about investing, financial planning, and life. In today's show, we're going to cover earnings on Delta, JP Morgan, BlackRock, and Morgan Stanley, all the big banks and some travel. Trump's stance on 10% credit card rates, buying mortgages to lower rates, and what's going on with his letter to Jerome Powell and the stock market's early winners. And information that we share, friends, is subject to change and should not be considered as investment advice. Please see the very long disclosure at the end of the show. Today, we'll start with a quote from the great MLK. It is MLK Jr. Day. And he said, and he's very quotable. Now, this is the one I chose. It says, life's most persistent and urgent question is, what are you doing for others?
Love that.
I love this. A team before me, always focusing on the other person. Winston Churchill said something similar. We make a living by what we get, but we make a life by what we give. The more we give, the more we receive. So God bless MLK. Paul?
Love it. Love Martin Luther King. It truly changed all of our lives, changed this country for the better. This is our family values bracelet. And the third value is honor of Martin Luther King, which is others focused, exactly what Gio just shared. And two quotes we've already shared with the team and some of our favorite clients this morning. Martin Luther King's dream, as he dreams of a country that one day his four children are judged by the content of their character, not the color of their skin. And we talk a lot about character and integrity. I love that. And we'll talk a little bit about the unhurried life like we did this morning. But one of my favorite quotes for perspective is a close personal friend of Martin Luther King asked him, "My dear Reverend, with all that you have going on, how can you afford to spend 3 hours a day in prayer?" And he simply replied, "My dear friend, with all we have going on, how can I afford not to?" Just
Oh,
about making first things first. And what a great example he was. God bless Martin Luther King.
okay. Yeah, awesome. Well, this past weekend, I had a fun time carrying a 25-day-old around the house, keeping her asleep and listening to earnings calls. And so we're going to run through some of the earnings call. Delta is on deck, and then we'll talk
Mm.
about some of the banks. And so first, Delta was typically some of the first company to release earnings at a mixed quarter. I'll share how they did. Here we go. A great chart from App Economy Insights. Actually, reach out to the person. He does really fabulous work, really cool visuals here. So you can see mixed quarter revenues rose 3% to 16 billion, $300 million beat for the full year. Company generated $58 billion. Q4 growth was softer because of the 40-day government shutdown. And management estimated the government shutdown hit revenues by about 2 points and reduced pre-tax profit by $200 million. And so what's going on, what's going well for Delta Premium Seating, their seats are so comfy. They have screens everywhere. I don't know if they were the first, but they were one of the first to have free Wi-Fi for their members. So great experience. Their American Express partnership is going well. Earnings growth, the CEO, Ed Bastian, he estimated 20% earnings growth for next year, $3 to $4 billion free cash flow. So big numbers. And they're going to be investing in better fleets. So they did announce some orders for Boeing 787, 10 Dreamliners with options for 30 more. And so a lot of good things going well for Delta. I think they have the highest net promoter score as well. What's not working is main cabin. And so you have premium seating, you get first class, and you get main cabin. And so the people in the back, and they said that it's kind of slowing down. They were optimistic that main cabin will start improving in 2026. We will see that. We will see what happens. I don't know if this is a true representation of the K-shaped recovery. Again, the rich getting richer, the poor not doing so well. And I only say that because according to the Bureau of Transportation Statistics, 49% of Americans flew on a plane in the last 12 months. So flying, I don't want to say I'll say it, it's definitely discretionary. I don't know if it's luxury, but flying in a plane, not everyone does it. I actually saw in their statistics, still it's like 90% of Americans have flown on a plane. So 10% of Americans have never been on a plane before, which is crazy to me. And so a lot of good things are going on with Delta. Paul, any thoughts?
Yeah, we love Delta. That is our airline of choice. I think it's crazy that allegedly 51% of Americans did not fly in the last 12 months. That's almost unbelievable as often as we travel. But we love Delta. I think a few key things. One, just as a company, Gio, you often talk about the importance of free cash flow and operating margin. And obviously, Delta is excelling in both of those areas. But more importantly, we always talk about the health of a firm being based on one client retention. We've been doing this for 28 years and our client retention is 99.99%. So that's so important to us. And the net promoter score is all about that retention and also referability. So I think those are great. Just going back to the client experience and how important that is. And you mentioned lots of things that Delta's done really well, like the Wi-Fi, the premium seating, just to enhance that client experience. Like I love the Delta clubs. Those are little things that make a big difference while we're traveling, having access to that. And then the consumer, we often talk about how 70% of the economy is based on consumption. So as long as Americans are flying, eating out, traveling, spending money buying $7 coffees, then the economy is thriving. And, this is just confirmation so far, so good. I think Q3 numbers were what, 35% better than anticipated. And initial forecast for Q4 is what, over 5%, which is
Hmm.
wild to think about. So far, so good.
Yep. Agreed. I think the banks have a better kind of bellwether to see how the consumer is doing. So I wrote some notes down after listening to the earnings call of JP Morgan, the largest bank in America. This is how they did. Net revenues grew 7% year over year to $45.8 billion. That's a $500 million beat. The beat was driven by a 40% jump in equities trading and strong fixed income results due to the market volatility. And I did pull some interesting quotes from the call. They said consumers and small businesses remain resilient. We continue
Mhm.
to monitor leading indicators for any signs of stress. And despite weak consumer sentiment, trends in our data are largely consistent with historical norms, and we are not currently seeing deterioration. CEO Jamie Dimon, this is the guy who always talks about dark clouds and cockroaches. He said the US economy has remained resilient and but conditions do not appear to be worsening. Meanwhile, consumers continue to spend and businesses generally remain healthy. They are cautious because of just multiple good years in the market. So they did have some rhetoric just to say, hey, we're cautious and stuff like that. But they're the biggest bank in America. They need to stay cautious. They did mention that they're the new issuer, obviously, of the Apple Card. They're taking that over from Goldman Sachs. They call the Apple acquisition, quote, economically compelling transaction. The integration is going to take 2 years, which is crazy. And they said it's because Apple created a brand new stack just for the business. Of course, Apple would do that. So it's going to take a long time to integrate that within their system. So it's going to take time and resources. And um, let's see, so they did take a $2.2 billion hit for the credit reserve to build that Apple Card program up. But then Jamie, he did mention like he's very optimistic for the macro backdrop for the next 6 to 9 months because of the fiscal stimulus of the big beautiful bill, deregulation of the banks, and he also mentioned the Fed buying $40 billion of T bills. So all of this is very stimulant to the economy. The biggest risk he sees geopolitical. Obviously, that's always a thing, and budget deficits. So those are the two things that he are talking. He was mentioning at the end. He said the capital markets of the world are going to grow dramatically over the next 20 years. What a great sentence, because it's true. I mean, I think now I'm forgetting. I should know this, but the Dow is about to hit 50,000. I wonder where it is now. And it was 10,000, a couple decades ago.
49,131.
Almost there, almost there. And the last thing he did mention, there's 320,000 employees that work at JP Morgan, and they spend $300 million in healthcare insurance for their employees.
Wow.
Big numbers, big numbers. Big bank, big numbers. That's what you get. Okay. Any thoughts on JP Morgan, Paul?
Yeah, lots. Wow. I mean, that's a city, 320,000 people. That's a city, not a company. That's pretty incredible. We talked about the importance of the consumer, which they just again validated. And then two of my favorite words, small businesses and resilient. What 80+% of businesses in
Mm.
America are considered small business. So the fact that they're resilient and doing well is super important to our economy and just the general financial health of America. So that's all good news. I love it. And then
Yep.
capital markets growing exponentially. We love that.
Oh yeah, 100%. We're in the right business, and people should be optimistic. If your time horizon is less than 1 3 years, and you want to put money in the stock market, boy, you will be. You could be very very happy or very very sad.
Lots of volatility.
But yeah, exactly. So it's the stock market. I hate, I don't want to call it a game, but the longer you play in the game, the better the results that you get, both from a positive performance perspective. And I'm talking about diversified portfolio. If you're just in one stock and hey, laser eyes, this is what I'm gonna do, then that's, you never know with those types of investments. But if you're in a diversified balanced portfolio, uh, the indices itself, they recycle a lot of companies. It's the companies are fighting for market share. They're fighting for our attention. It's amazing that we can invest in some of the most prominent companies with a click of a button. Amazon, Apple, Nvidia. I mean, unbelievable companies that we can just invest in and just be a freeloader
Yeah.
essentially. So that's amazing. So okay, I want to move to Morgan Stanley, and one of the largest wealth managers in the business. This is their results here. So they had a record year. Q4 revenue rose 10% year over year, $17.9 billion, $140 million beat. GAAP EPS of 268. That's a 26-cent beat as well. They're definitely a diversified business. Their institutional securities or their investment banking is within their institutional securities. Revenues rose 47%. So a big number there. A lot of that because of the debt underwriting. And where did the debt underwriting come from? AI infrastructure boom, including major data center deals. So that helped Morgan Stanley. They also brought in $122 billion in net new assets for the
Wow.
firm. With
Amazing.
pre-tax margins of 31%, so big numbers. They also they acquired a company called Equity Zen. So a lot of these investment managers are getting into private markets in one way or another. We'll talk more about that from BlackRock. But
Mm.
Equity Zen does give people access to a private market ecosystem. And so that's some of the investments that they are doing. Uh, again, the CEO, he mentioned that really good markets the past couple of years. He also mentioned like he wants to be cautious, but none of these CEOs will ever say, "Hey, it's going to be double digits. We're all in. We're actually going to use leverage." They will never do that because they are chief risk officers. They have to see all the risk for the firm, and so they need to have kind of a balanced footing. And so those are some of the results from Morgan Stanley.
Yeah, I love that, and I appreciate them being cautious. I like the idea of under promise, over deliver, and it's amazing too. Just when you look at the scope of Morgan Stanley versus J.P. Morgan, um, their net margins are considerably different. I mean, what
Mm.
7% versus 19%, and bringing in 122 billion of net new assets. I mean, that's mind boggling. That's an incredible number.
100%. And Morgan Stanley, I think 25% of their business is international. JP Morgan's much bigger than that, but it's 7% of a bigger number
Yeah.
is better than a bigger number, a smaller pie, if that makes sense.
Sure.
But yeah, we have really great financial institutions here, great technology here, great companies. We should continue to outsource those resources, those high margin resources to the rest of the world. Okay, last one here is BlackRock. BlackRock is the gorilla in the room when it comes to investment management, and they pass by the $14 trillion assets under management. You can see here some of the numbers: 23% year over year growth to 7 billion. Um, Investment advisory performance fees up 67 percent there. Margins are healthy at 18% from a net income perspective, and they brought in nearly $700 billion in total new capital. So a lot of new money entering BlackRock, and they're getting into all sorts of things, specifically private markets. We'll talk about that in a little bit. I actually want to touch on their some of the quotes that their CEO mentioned. So they did mention that they were doing an aggressive push into private markets, and he said it's reshaping the firm's profile. They recently purchased a big kind of private credit manager at HPS, and so that grew their EM by quite a bit there. Um, they have nearly 150 products across ETF and mutual fund, and over 1 billion in flows. So again, they are the number one ETF franchise, top five alternative platform, and so they continue to grow. One thing that they did mention on the call is they're writing off their investment in Circle. And if you remember, if our audience members remember Circle, that was the stable coin provider that went public last summer, and it jumped almost 800% in just a few months. But since that high, it's gone down 70%. And so hopefully you didn't put all your money in that basket. And so they are writing that down and contributing a portion of their stake in Circle to their existing donor advised funds. That's what they said. They see a ton of a demand going into ETF, SMAs, outsource CIOs, so chief investment officers, and it's paying off from a revenue perspective. That is where they see the fees growing. They are in lockstep with the current administration to launch target date funds that include private markets. I think that
Yeah.
was one of the things the current administration wanted, more access to private markets to more people, and the private market providers are are offering them. So another good quarter, and they're still optimistic of the capital markets as well. So being the largest, one of the largest money managers, or the largest money manager, it's hard not to be optimistic from their vantage point. Your thoughts, Paul?
The numbers are staggering. I mean, 18 trillion, 700 billion. BlackRock is becoming a juggernaut for sure. On the private piece, it's interesting. Like we had this conversation several times last week with some of our best clients. Most people don't realize there's 14,000 McDonald's in the United States of America, but there's 19,000 private equity firms. So
Hmm.
everybody wants access to private equity, private real estate, private credit, but it's very important that those are properly vetted because not all 19,000 of them are going to be winners. So the
Hmm.
importance of due diligence is critical. So it's interesting that they're going to be participating in that in a target date or glide path fund.
Hmm.
Um, the other thing I just want to make sure it's clear for our listeners. Everyone hears BlackRock and they think, what is it, Blackstone? And they talk about Trump's potential ban of institutional investment firms owning private residential real estate. And so I think it's important that distinction's made so clients don't hear BlackRock and run for the hills, so to speak.
Percent. Yeah, Blackstone is going to be affected the most of the number one alternative manager, I think, in the world. I think they manage. I'm pretty sure they manage over $1 trillion. But Blackstone does have some investments in single family homes and getting into private markets. But Blackstone, by far, is the leading um, issuer there. At the same time, we're going to talk about this in a later segment, but let's tackle it now. That the private institutional companies buying single family homes, it's only about 1% of homes of homes in America. At the same time, real estate is so local. So even though here in Omaha, we don't see a ton of institutional buyers, in Phoenix, it might be completely different.
Hmm.
And they would probably uh, cheering for institutional investors to get out of their market. And so it's definitely a balancing act. But enough to say Blackstone would likely get affected. Their stock price did get affected when the news came out. We'll see what happens moving forward. And so Trump wanted to tackle a couple of items from an affordability perspective. The first one that he mentioned, well, maybe it wasn't the first one. Maybe it's the first one that I'm bringing up. But he wants to cap credit card rates at 10%. And so right now, I guess the average credit card rate is 22%. That's what
Crazy.
people are paying. So you can just see This is, I guess you can say, since '94. You know, over 2 decades here. It was usually like between 16 and 12%, but then the last couple of years, that's really ballooned up, and you can
That's
see that to 20.
insane.
But you can see during this whole time, it's never been less than 12%. And so, trying to cap this at 10%, that I think Congress is going to have some work to do. JP Morgan did have something to say about this. They said cardiac system, excuse me, the card system is a highly competitive market. What's actually simply going to happen is that the provision of the service will change dramatically. Specifically, people will lose access to credit, like on a very extensive and broad basis, especially the people who need it the most, honestly. So that's a pretty severely negative consequence for consumers, and frankly, probably also a negative consequence for the economy as a whole right now. They are talking their own book, obviously. They issue their own credit cards and stuff like that. At the same time, um, there's a couple of stakeholders that are subsidizing people who pay all of their credit cards on time and get these really great rewards. One is the companies, the stores that we go to, where they have to pay 2 to 3% to the issuing credit card provider, because it's much easier for us to use a credit card rather than us to take out cash. Who wants to take out cash? And then the other cohort is people who don't pay their credit cards on time and pay these 22% interest rates, who have very low FICO scores, very low credit scores, and unfortunately that is the case. So if credit card companies don't think they're going to get a return on their money, and they're going to start seeing higher default rates, then they're just going to exit that business. Um, at least that's what it seems like. If we can force them to change their ways and be more altruistic, hey, I'm all for it. But companies don't work that way, and so if they're not offering these credit services, then consumers might just go somewhere else that may with even worse provisions. Who knows? This is something that's an ongoing process. I mean, I think the analysts who are kind of grilling the CFO and CEO of JP Morgan during the earnings call, they were like, we just heard about this like a couple hours ago. There's a
Mhm.
lot of things that are changing. So we'll see what happens from here.
I'm super conflicted on this. One, those numbers are staggering. The fact that it's increased from basically an average of 14% the last 30 years to now 22%, particularly in this interest rate environment. Clearly, that's to accommodate for risk. But this is one of those, I think, classic examples where we're talking about treating the symptoms, not the root problem. And the average American spends about 110% of their income. And as we know, deficit spending never works. Proverbs 22 says, beware the borrower is a slave to the lender. And we don't want to be a slave to anyone or anything. But man, like you said, the people that need it most are actually the ones that are just getting buried by these rates. So I'm just super conflicted on what the answer is.
Yeah. But again, I think, well, the public markets initially hurt MasterCard, Visa, the credit card providers, but we will see, how the story unfolds. So that was one idea. Obviously, we tackled the other one with institutional capital getting out of the single family home buying business. And the other one was Trump announcing $200 billion bond purchase in bid to lower mortgage rates. So this was something that they wanted to do. Freddie and Fannie Mae, they can buy a bunch of mortgages and lower the interest rates. I think that's a great idea. I think it's under their purview to do so. Obviously the only hiccup is, we have to have some guardrails, because we don't want another 2008 financial crisis to happen. And so I'm all about that. I think that's a great idea, buying up a bunch of bonds to lower mortgage rates. So, and the 30-year mortgage rate has been coming down. I think it was 7% last year. It's at 606
Um,
the last time I checked. So that's very good
I was
for
starting to see it
people,
dip
first time
under six.
buyers. Yeah. So that's great. Any thoughts on this one, Paul?
Well, yeah, we were talking last year and the year before how the American dream of homeownership was becoming less and less realistic. And so seeing those rates drop back down has been really a game changer. We've also seen some price compression and the market's down about 17 to 20% from its high in 22 ish. So certainly moving the right direction. But again, common theme: debt, leverage. Making things more affordable for the average American.
Hmm. Um, that is correct. Um, well, the other thing that the administration has been trying to have is the Fed governors to lower rates. And so last week, Jerome Powell, he did receive a letter. Um, essentially, actually, I have a clip for it. Let's hear what he had to say.
Good evening. On Friday, the Department of Justice served the Federal Reserve with grand jury subpoenas, threatening a criminal indictment related to my testimony before the Senate Banking Committee last June. That testimony concerned in part a multi-year project to renovate historic Federal Reserve office buildings. I have deep respect for the rule of law and for accountability in our democracy. No one, certainly not the chair of the Federal Reserve, is above the law. But this unprecedented action should be seen in the broader context of the administration's threats and ongoing pressure. This new threat is not about my testimony last June or about the renovation of the Federal Reserve buildings. It is not about Congress's oversight role. The Fed, through testimony and other public disclosures, made every effort to keep Congress informed about the renovation project. Those are pretexts. The threat of criminal charges is a consequence of the Federal Reserve setting interest rates based on our best assessment of what will serve the public, rather than following the preferences of the president. This is about whether the Fed will be able to continue to set interest rates based on evidence and economic conditions, or whether instead monetary policy will be directed by political pressure or intimidation. I have served at the Federal Reserve under 4 administrations, Republicans and Democrats alike. In every case, I have carried out my duties without political fear or favor, focused solely on our mandate of price stability and maximum employment. Public service sometimes requires standing firm in the face of threats. I will continue to do the job the Senate confirmed me to do, with integrity and a commitment to serving the American people. Thank you.
So that was Jerome Powell addressing the conviction that he received. No political ties here. I think if you try to invest just from your political affiliation, we've seen and we've shared that with many of our clients and friends and family that it doesn't bode well for a long term performance. So just from a stock market perspective here, that we do need independence of the Fed. At the same time, it's kind of a myth there because the president actually appointed Jerome Powell, many years ago. And so there's always going to be some political bias in the election of the chairman itself. So that's one thing. At the same time, spending over $2 billion on a building, that's a lot. We just renovated our office, and we know you can go over, but not so much over. So there's definitely questions that need to be answered there. But I think a lot of past chairmen said, "Hey, oh, we need a independent Fed." And at the same time, in May, Jerome Powell is gone from the chairman. He's still going to be part of the Fed governorship. And so there's going to be somebody else not named Jerome Powell, named chairman by the end of the year. So, and we will see what he decides to do. So, and I will say that when the media kind of approached President Trump on this topic, he said he had nothing, he didn't know about it. He wasn't sure who did that. But obviously, he has been very aggressive because he thinks interest rates should be lower. Obviously, there's kind of a balance of power there. But we will see. I think the bond market didn't think too much of it. Interest rates didn't change so much after or before, just because I think removing Jerome Powell would not be very good for the bond market specifically. Your thoughts, Paul?
Well, as we like to say, the issue needs to be the issue. So when we look at this and even hear his 90 seconds, I think, one issue is we have this building and what is a board acted with integrity, in the scope of law. That's one issue. Then
Yes.
the second issue is his relationship with Trump and as Fed. And it's no secret Trump and Powell don't spend Thanksgiving and Christmas with one another. They've been adversarial for a long, long time.
Mm.
And my perspective is, holy smokes, he's going to be gone. His term has expired in 4 months anyway. Like, I think this does have, he talked about threats, intimidation multiple times, ongoing pressure multiple times, preference of the president. I do think it's important that the Fed is, to the best of their ability, objective when it comes to setting rates. And, I could see this as a power play of, okay, he's done in May as chairman, but does he have some, participation still on the board? Something like this could really just, wipe him from the map altogether.
Hmm.
So is there a little bit of posturing? Probably. It's kind of like, yeah, can't we all just get along? we got we got 4 months left. The economy's humping, things are in a great spot. I think this is largely on the intimidation pressure side needless. The building side, I'd like to see more due diligence and more data if that was above board. But on the pressure political side, I'd rather like, hey, let's finish well. It's not how you start, it's how you finish. Had a good run, economy's in a good spot. Let's get through these next 4 months and move on with our lives.
Hmm. And our last segment is just that, continuing this bull market, and the bull market is alive and well. What I'm showing here is the S&P 500 on the orange line. This is as of the last Thursday, last Friday, up 1.4%, and then the equal weight. And so there's 500 companies in the S&P 500, and so they're uh, the S&P 500 index is priced by market value. So the bigger you are, the higher weight you have in the index. Equal weighting them is that Apple and Home Depot have the same weighting to the index. And you can see when we equal weight the S&P 500, the S&P is up 3.8%. So this is a broadening of the S&P 500,
Yeah.
and it's not tech led. So what I'm showing here now is this different sectors. Industrials up 7%, materials up 7%, energy almost up 7%. And then you can see technology at the very bottom there, down 60 basis points, 0.6%, as well as financials. Financials had a really great quarter from what we just talked about, but they had a great 2025. And so their valuations kind of went up a little bit. So I'm okay with financials kind of being flat just because of how great a year they had last year. So again, last year or maybe 2, 3 years ago, it was just like Mag 7 concentration. Now it's broadening. This is what you want as an investor. You want small caps, you want mid caps, you want different sectors to continue to do better. That will help the bull market keep rising. So all good from an investor perspective.
Yeah, that's all great news. Very different story than we've seen the last 3 years. If you said dominated by the Mag 7 here recently. So this is actually healthy for the markets. This is healthy for those companies. So I love seeing that equal weight, way different story than the past few years.
Yep. Yep. Great. Great. With that, friends, we always like to share a one little nugget of wisdom. Hopefully, you got a little bit in the last 30 minutes. But Paul, you shared a really interesting kind of paper recently, just on being hurried but not wanting to be hurried because that's stressful. Please share that.
Yeah, I love that. Thank you. That's something we've been working through as a team, and having some clarity breaks. And just this is playoff time in the NFL and college football, and often in business and life, when the pressure, the moment is on the line, it's do or die. Our natural tendency is to push harder, force it through. And just such a great analogy. What do great teams do? They take a timeout. They take a timeout to collect themselves, to take a pause and really evaluate, hey, what's the best decision for these circumstances? And we do this periodically throughout the year called clarity breaks. And the thing that struck me most is we've been studying this concept of a hurried life. Like, number one, the surefire sign that you suffer from hurry sickness is how many times do you push the elevator close button when you get in the elevator. Number two, they interviewed 1,000 employees or partners of 100 of the top CEOs in business. And Gio, do you remember what the two most common words that their employees and partners use to describe their leaders?
Well, You did ask me, and I was wrong at first because I thought it may be ambitious, demanding,
I
but
wish.
you said
Yeah, I
but
wish
you
it
said
was ambitious, humble, something. But sadly, the two words they use most to describe their leaders, CEOs, are hurried or stressed. And I'm like reading that, and Sarah made fun of me because we're on vacation. I just start crying, and she's like, "You're such a big baby." I'm like, "Honey, I don't. When I'm gone, I don't want to be remembered as hurried or stressed. I want to be remembered as joyful, compassionate, others focused. I want people to say, I can't imagine my life without Paul Ludacka." So I think that's been really fascinating, and we've been working on that as a leadership team, very consciously, very intentionally about how do we want to be remembered.
well, I'll describe you as lovable, and I love just being around you, my friend.
I
So
love you too.
obviously, yeah, just running a business, it is stressful because we want the best out of our team, we want the best out of our client, and we want to provide the superior service to our client. So it's a work in progress. So thanks
Oh,
for sharing that, Paul.
thank you.
And friends, if you have any questions, please send them over to lwp@nm.com. If you like the show, please like and subscribe and send it to a friend. And with that, we will see you guys next time.